Guys, banks are in trouble. Nobody is buying homes right now, and home mortgages are a big part of how banks make money. In fact, banks are getting so desperate, they are back to offering zero down mortgages with zero closing costs. Yeah, you might remember those types of loans prior to the 2008 housing crash, and I have my predictions as to why they might be willing to offer these. So let's get into it. Bank of America has this new mortgage product that is zero down with zero closing costs and requires zero mortgage insurance. This is for first-time home buyers in what they say to be predominantly minority communities. And there will be limitations to who's eligible based on income and the location of the home. Now, they are portraying this almost as a humanitarian product to narrow the gap between minority homeownership. And while I recognize the need to narrow this gap, homeownership is one of the biggest ways middle-class people build wealth. I usually trust big banks to only be self-serving. So I'll explain later in this video what really concerns me about these loans, so you can decide if it's a mortgage product you want to use. They're calling it the Community Affordable Loan Solution, and some of the initial areas that will be offered these loans are in parts of Charlotte, Miami, Dallas, Detroit, and Los Angeles. Now, these loans are not based on credit score either. They will instead be using banking history as it relates to paying recent bills on time like utilities, rent, and insurance. Those who apply will also be required to complete a home buyer certification course to qualify. Now, there is a disparity in the gap of homeownership based upon race in the US. General homeownership rate is at a 65.5% rate across the US, but Asian Americans are only at 61.7%. Hispanics at a 51.1% rate, and Black Americans are only sitting at a 43.4% homeownership rate. This is an obvious result of the wealth gap between races in the US, as Black Americans are more than twice as likely to be rejected for a home loan. Now, I'll be the first one to tell you that in the long term, smart homeownership can be important to building personal wealth. Everyone needs a place to live, so you might as well build equity. But does it concern me that these mortgage products are just now becoming available when it's obvious that the housing market is at its most unaffordable level in 30 years? Absolutely, and here's why. And this is why I question the intention of this mortgage product. Why is it coming out now? Why didn't it come out 2 years ago when the housing market was red hot and homeowners were making tens to hundreds of thousands in equity over a year or two? Well, we know that mortgage applications have dropped to their lowest level in the last 22 years. We also know that interest rates are climbing and plan to climb through the end of 2023. And as I've mentioned before, for every 1% increase in the interest rate, you'll be paying about 10% more in your monthly mortgage payment. Well, here's my thoughts as to why they are coming out now. The reality is, big banks like to give loans to people with good credit scores and large stable incomes, but those people aren't buying. So when that's not an option, they are willing to take on what they consider more risky borrowers, even if it may not be in the best interest of the borrower. Remember that in 2008, it was the big banks that got bailed out, not the low-income families with adjustable rate mortgages. That being said, some of the current low-income families have been desperate to buy a house since lending qualifications became so difficult after the last housing crash. And I believe the banks are hoping these people are so desperate to get into a house that they won't care if the home is overpriced. And I wouldn't be surprised if Bank of America thinks to bundle these loans in mortgage-backed securities and sell them off as soon as possible. And I also wouldn't be surprised if the banks thought they might get another bailout if this program goes belly up. This would essentially let them stay flush with cash during this slow housing market and then cry for a bailout when these bad loans go belly up. But where will that leave these low-income borrowers? Well, if there is a housing crash, it could leave these families house poor and underwater. Let me explain. Housing affordability is already at its worst level in 30 years, and this loan product generally has a higher interest rate than a traditional FHA loan. To give you an idea, the current mortgage is costing buyers on average 32.7% of their household's income. That's 40% over the long-term average of 23.5%. Anyone paying over 30% of their household income to a mortgage is starting to be house poor, in my opinion. Now let's talk about the risk of these low-income families easily getting underwater on their house. The term underwater means that you owe more on your house loan than the house is actually worth. As an example, if you were to buy a house for $250,000 using a bank mortgage, and then the house lost $50,000 in value the next day, making the house only worth $200,000, you would still owe the bank $250,000. This would mean you were $50,000 underwater. Now, if these low-income families didn't put any money down and their house suddenly lost 20% of its value within a year, which very easily could happen in this market, they are almost certain to be underwater on their new loan. Not only that, but since they didn't put any money down, these homeowners are not motivated to stay in that house, paying that mortgage. You might as well be writing foreclosure slips to a lot of these families. Now, there's one caveat to this. In general, lower income neighborhoods do not see as large of a swing in prices during a real estate bubble, unless the neighborhood is going through gentrification. So if it was a neighborhood that was a low-income area and still is a low-income area, you might have seen some increase in prices during a bubble, but nothing like more affluent neighborhoods. This, in effect, would provide some cushion to potential equity loss if the housing market crashed. So I would think that Bank of America is strategically selecting communities where they think that equity loss will shadow the principal paydown being made by borrowers. As an example, let's say you buy a house that costs $224,000 and your monthly payment is $2,000 a month. And over the course of the year, the house loses $12,000 in value from a housing market correction. But you as a buyer paid off $12,000 in principal to your loan. This would mean the buyer gained no equity in the house even after making $24,000 in payments. But at least the house is not underwater either. Now, one of the concerning things some of you may have noticed is this loan product is only available in certain low-income areas. This may have made some of you think of redlining, right? You can't help but think of economic segregation when they offer it only in specific communities. But as mentioned, I think this has more to do with current prices and potential home value losses in those areas than anything else. Okay, so now you know my concerns regarding this program. It doesn't mean that it's bad, but I want you to look at this with eyes wide open. If you take one of these loans, you are at risk of later being underwater in your mortgage if the housing market goes down. If you're going to be living in that house for the next 10 years, then this may not matter to you. And who knows, this may be the first and only time some of you will be able to qualify for a mortgage. So each person needs to decide if this program is right for them. Just keep in mind, the bank isn't doing this as a favor. They are doing this to make money. You have to decide if it makes sense for you when a potential housing market correction could occur. I do think that mortgage products such as this one are a big indicator to the desperation of banks right now. We already know that several mortgage brokers have gone out of business or let go of a large portion of their staff. And as I said before, the federal funds rate is planned to be rising for the next year and a half. That means that anyone who is hoping for monetary easing to prevent this housing market from crashing is in for a rude awakening. The new economic data has shown that inflation is still occurring even with the recent interest rate hikes. So the Fed has no choice but to continue raising interest rates. And let's be honest, our government is addicted to spending. I have to assume our government will continue to spend money it doesn't have, even when we have uncontrolled inflation. Really, what we are going through is a bit different from our other recessions over the last 30 years. It's been a long time since we've seen this level of inflation across the country, which makes it difficult to predict how the inflation will ultimately shake out in the real estate market. From one side, you can say that home building materials are more expensive than they were 5 years ago, so that forces home prices higher. But on the flip side, you could say that groceries and other daily expenses are higher, which leaves families with less money for rent or a mortgage. And it's household income that fundamentally drives the prices for everything. Effectively, we are not seeing wages increase at a rate that keeps up with the housing prices. So this almost certainly spells out a housing correction. But just like the Fed wasn't able to accurately predict our current inflation or how high they would have needed to increase the federal funds rate, It will be anyone's guess on where housing prices will settle. So just keep that in mind. All these people that are making housing market predictions can't accurately incorporate inflation into their projections. Most of their projections are based off of our traditional 3 to 4% inflation a year. Think about it. The Fed, who controls the circulation of our dollar, can't accurately predict inflation. So how can anyone accurately tell you how much the median wage will increase this next year? Yet that's a critically important factor when projecting future home values. So these future estimations about what will happen to home prices are based on today's data. Always keep that in mind when you listen to these real estate gurus. Let me know what housing markets you guys are looking at down in the comments. Everything in this video is just my own opinion. Don't take it as legal or financial advice. Here's another video about the housing market, and you guys have a great day.